All right, call the meeting to order. First order agenda item is to welcome our new board member, Robert Porter, joining us, so welcome.
Good morning, thank you.
Thanks for being part of the board. And then roll call.
Yes. Landon Moore.
Present.
Mark Gardner.
Present.
David Holly. Robert Porter.
Present.
Councilman Dodson. Stephen Carter. Gregory Coleman. Derek Challenger.
Present.
Jeanette Fernandez.
Present.
Trey Burke. Kimberly Sinclair.
Present.
Brian Birnbaum.
Present.
Jim Whitney.
Present.
John Morrison.
Present.
Harry Wilkes.
Present.
And we do not have a quorum today. We have 3 members.
Okay. We'll skip over approval of the minutes. First item other than that is just a quick update on the OPEB trust. I think at the last meeting or two we were questioning a value that was presented that seemed like it was representing a loss that didn't sort of align with what markets had produced over the last few quarters, and Derek, I think you looked into that and got an answer.
I looked into it. There was no loss. I think it was just a misunderstanding while reading the statement, but it was progressing. And I had my doubts about the loss because of the market it would have been inconsistent with what I thought it would have been. So it was just a mistake. So there is no loss.
Okay. Good, and please send around the updated report or value that you have. I think you might have already sent it.
I'm not sure if I sent it to everyone. I know I sent it to you, but I will send it to everyone if I hadn't already done so.
Okay. So we have our guests from Greystone and John Hancock. Looks like Greystone, Brian, Jim, and Mark, you're up first.
Great. Thanks, Landon. Good morning, everyone. It's great to be with you in person, see everyone again. We're going to go through the usual report. Jim's going to talk about sort of the outlook and what's going on in capital markets and some of the things we're focused on. I'm going to talk a little bit about the portfolio. And then at the last board meeting, we talked about coming with a deeper dive at this meeting on the alternative investment strategy, which is why Mark Dietrich has joined us. Mark is a member of our outsourced chief investment officer group at Morgan Stanley. He's part of the team. Jim, Mark, and I work collectively on this portfolio. But Mark's going to talk specifically about the composition of the alternatives portfolio and some of the things we're thinking about as we head into the early part of next year as well. So with that, let me turn it over to Jim, and then I'll come back and talk about the portfolio.
Great. Thank you, Brian. Good morning, everybody. Great to be with you today. Can we move to slide 5, please?
I got it, Jim.
So I want to spend a few minutes just talking about our forecast here on slide 5, and I'll just hit the salient points for you. I think the first thing I'd like to highlight is our forecast is that real GDP should come in about 3 to 3.5% for the third and the fourth quarter. Just last week I saw an estimate of 4.25, but we're a little bit more conservative than that. We see inflation, CPI, peaking at around 4% sometime in the second quarter of 2026. So that's certainly well above the 2% target, but we think the tariffs will start to bite and be in full force sometime by the end of the second quarter. In terms of interest rates, the 10-year Treasury, we're still forecasting year-end target of about 3.8%. That's been our target for most of the year. It's right around there today, a little over 4%. We'll spend some time looking at earnings, which I think deserves a little bit more attention later in the presentation. But the earnings implied acceleration for the 493, other than the MAG 7, is 10% growth this year and 14% for 2026. So with that, that gets us more comfortable, more confident in our target valuation for the S&P next year of 7,200. So that's probably 5 or 6% from where we're at today. So let's look at slide 6, go a little bit deeper into what's been happening in the capital market since we last got together. Top of page 6, it's been really a pretty extraordinary 6-month period in what we think is a 3-year-old bull market. At the top of that slide 6, what we're looking at is largest 6-month returns. And as you might expect, you get the largest return coming out of a recession. And we just experienced one of the largest 6-month returns coming out of the post trade rules that the Trump administration announced on Liberation Day. So pretty remarkable recovery. And if we look at the bottom of the slide, the return since that April low, Liberation Day, market is up about 34%. Next slide is, I think, really interesting because we haven't shown you a slide like this in quite some time. If I can focus your attention on the red boxed area, that's the S&P 500. The dark blue is the performance year to date. This is as of October 13th, so the numbers are a little bit higher today, closer to probably 17%, but we're looking at 14% for the S&P year to date. The light blue is the 2022 to 2024 period. And what's interesting here is that for the first time since the tech wreck of 1999, we're getting outperformance from non-US stocks. So if we look at the left, MSCI All World Index X the US, up over 26%, and then if we look at the Emerging Market Index, it's almost 30%. So almost 1,000 basis points of outperformance over the S&P by having a diversified portfolio. Even bonds are starting to drive some of the results in the portfolio. If you look at the Bloomberg US IG index, that's up about 6.7%. So it's been a year where having a very well-diversified portfolio is at a lot of value. We'll demonstrate that as we go through the portfolio results in a few minutes. Why is this happening? Well, one is the dollar weakness. The dollar's declined by 6 to 7% this year. There's been concerns about tariffs, so investors moving some money outside the United States. There's been some concern about the Federal Reserve independence, and of course, growing U.S. government debt. This next slide gets dated pretty quickly after a Fed meeting. Chairman Powell and the committee cut rates about a week ago. There was some very significant rate expectation cuts built into the market prior to the meeting. I think the committee and Chairman Powell spoiled that party by warning that maybe a rate cut in December may not happen. And I thought one of the quotes he said in his press conference was, "What do you do when you're driving in a fog?" Because they don't have enough data to make decisions. It's just, you slow down. So expectations for rate cuts in 2026 started to moderate after that Fed conference, but the probability of a 25 basis point rate cut at the December 10th meeting is still around 70%. But for the January and March meetings next year, it's fallen sharply. I think this next slide really sets up the backdrop of what's happening in the capital markets. So I'm going to spend a couple of minutes reviewing this. On the far right, we're looking at earnings revision breadth. So we've seen an extraordinary increase in earnings revisions, and we'll look at what those revisions are in just a few minutes. But when you take a look at the earnings revisions, and then you look at what is the 2026 bull market case, it's not surprising that the market's doing exceptionally well this year. So what do we have? We have deregulation, we have clarity on individual and corporate income tax, we've got generative AI CapEx boom with the hyperscalers, we have inflation that is right around 3%, so not at the Fed's 2% target, but certainly not at 9%. We have GDP growth, as I talked about earlier, somewhere between, we'll call it 2.5% and 3.5%. We have unemployment at 4.3%. So when you take that backdrop and you think about a Federal Reserve easing into that market, that creates what we refer to as a risk-on market. And I'll show you some slides to demonstrate exactly what that means. But really, it's a perfect backdrop for investors to take on risk. And as we look underneath the current, we certainly see some frothiness. And maybe the overall margin of safety has changed over the last year and a half. And we think about this because we look at the target rate of return for the portfolio, our 7.25%, and what we spend time thinking about is where is the best place to allocate your capital to make sure that we achieve that hurdle rate. So that's a topic we'll come back and spend some time on. But you've got a handout. These slides weren't prepared at the time that we put this together. But I just want to amplify. I want you to look at this slide. It says U.S. equities post-Liberation Day. To amplify what I was talking about perhaps some of the froth underneath the current. So you have the S&P 500 and the NASDAQ on the left. Those are the gray boxes, up 35% and 45% respectively. But then if you look to the right, you can see AI, anything AI related in that bucket is up, almost 80%. Non-profitable technology companies up 96%. The most shorted stocks, so these are by definition sort of the lowest quality stocks, up about 100%. And you can see the rest, right? Bitcoin sensitive up 200%, and the same for quantum. And if you look at the next slide, we're just zeroing in on small cap companies, just to highlight this point further. Since April of this year, all we've done is we've broken out the small cap index, which is the Russell 2000. It's a passive index. And the green line represents companies that are demonstrating negative earnings per share. And the blue line is companies showing positive. So the companies with negative earnings are substantially outperforming the higher quality companies that have positive earnings. Now, there's a number of potential reasons for this, but and one of them is if the Fed does increase rates, small cap companies are much more affected by a lower term structured interest rates than large cap companies. But there's a lot more going, and I think going on, and it ties back to the first slide I shared with you. So we think about this in the context of how we construct your portfolio. This next slide, I just want to spend a minute on because I think it really is the linchpin of the market for 2026 and perhaps 2027. If you look at just the upper left, we're looking at S&P 500 consensus earnings per share. And if you look at the Q4 24 to say Q3 25, earnings generally flat, maybe up a little bit. Yet the market's gone up pretty substantially during this time period. So most of what we've experienced is a market that's moved higher because of multiple expansion. Investors are willing to pay more per dollar of earnings. And maybe what the market was starting to sniff out is we want to get in front of the fact that earnings should be moving up higher, which is what we're seeing in this consensus chart. So markets has done exceptionally well. Earnings are about to turn up based on consensus numbers. But this is where the risk comes in, because if these earnings don't materialize and the market's already anticipating that, that's where that gap can close. Let's look at the next slide, the 493. We get a lot of questions about the MAG 7.
I just ask one question.
Yeah.
Prior the preceding slides, you were saying this is sort of the perfect backdrop for risk on, but the I guess you're saying that the takeaway there is the risk to that perfect scenario is if the earnings growth does not materialize?
The risk is that earnings expectations are ahead of the fundamentals, yeah. That would be the,
Or, Landon, the Fed doesn't cut as the market is expecting. Those are the two primary risks to equities as we see it. And there's plenty of reasons why they may not cut. Jim talked about inflation heading higher. It's highly unusual for the Fed to be easing monetary policy in an economy as strong as it is. Yes.
Is it another comparable risk, the valuations? Because right now it seems like between AI valuations and everything related to AI and just the overall market, the valuations are really high. So isn't that a major risk going forward? And the other question I had was, as it relates to all the projections, how much of this was pre-government shutdown and the issue that's associated with a prolonged government shutdown?
So the valuations are exactly where the market would suffer if earnings growth doesn't materialize and the Fed doesn't cut as the market expects. The PE multiple of the S&P is somewhere around 23 right now. That is high relative to its history. And it's high right now for a lot of the reasons Jim talked about. There's all sorts of hope and hype around AI and the impact that that's going to have. It's based on the fact that the Fed is cutting interest rates and the inflation is coming down from 9%. It's ticked up to a little bit north of 3% from where it was. But the other issue you raised is the government shutdown. None of this, the market doesn't seem to care about the government shutdown. It may, depending on how long this drags on. We're already in the longest period of a government shutdown, and markets are, touching new highs every day. So the longer this drags on, the higher the risk that it will have real implications for the underlying economy. So government opens up, economy can continue to chug along like it has been, as Jim talked about, let's just call it between 2.5% and 3.5%. If this thing drags on, those assumptions will start to slide lower. But the valuation is where, the biggest concern would lie if these things don't play out the way the market expects.
If I could just add one thing. The other thing we've been talking about at Morgan Stanley is something called a K-shaped economy. The haves, and the not haves. And the same thing exists in the stock market as well. So there's a saying that the stock market is not the economy and the economy is not the stock market, and I think that's a little bit about what we're seeing and what Brian was touching upon is you can have an economy that's slowing and starting to roll over, things like the government shutdown, among other factors. You can also have a stock market that ignores that because it doesn't necessarily affect them for a variety of reasons, and I think that's, when Brian's saying the market isn't paying too much attention to the shutdown, it's largely because of that. So just something to keep in mind. I mean, the top 10 or 20% of high-income earners in this country are supporting their account for something like 60-70% of spending. So it's a difficult environment as a whole when you look under the hood.
let's go back to slide 10 for a second, just to highlight Landon's point. So if we're looking at the third quarter 2025, you see the blue bar at 67.5. And then we move out a year to third quarter 26 estimates to $78. That's a 16% jump. And you can see that's a pretty significant move off of what's been a really choppy to flat earnings market. But this is the implicit risk that I was referring to. It's that expectation that we get there. And you can have geopolitical risk, we can have resurgence of inflation, we can have a lot of challenges that prevent us from getting it. That is the consensus.
Do you have a sense of what the P would be if the earnings were 75 or 78? What that would imply for PE ratios? Like, I guess that's the forward PE ratio.
Yeah.
Current is 23, but the forward is that more in?
The 23 is forward earnings.
23 is the forward.
The 24, 3 is the forward,
Yeah.
okay.
Yep. So the trailing would be, I don't even know what it would be. 30, maybe.
Okay.
I don't know.
So even, the market pricing in those higher earnings, it's even frothy
Any
based on
metric you
future
look at.
expectations.
Yeah.
And by the way, everything we're talking about right now, we take into account when we put the portfolio together, as Jim mentioned, and we'll talk about sort of the defensiveness of the active exposure we have in the market. And so when the market's up 24 or 20%, and we have a little bit of defensive posture because of the reasons that we're talking about, well, that has an impact. We don't generate as strong a returns in a rising market. But we'll get into that in a minute.
Yeah, which then ties back to this slide, which is when it does get frothy and you see a lot of speculation going on underneath the current, these are not the kind of managers that we're going to deploy your capital with.
You figured that's where it was leading?
Right. All right, let's move to slide 11. So this is the 493, really the broad market, stripping out the Mag 7. And what you see in this boxed area is the net income year-over-year growth. And rightfully so, the Mag 7 has had extraordinary growth. So they are very profitable companies, and top line, bottom line, so they deserve an outsized valuation. But what we're looking at and expect for 2026 is that those imbalances start to normalize, and the rest of the market sort of catches up, and maybe the robustness of the Mag 7 revenue and earnings growth starts to taper, which would be healthy for the market. This next slide, upper left, just indicating inflation still closer to 3% than 2%, which gives I think the Fed some pause for cutting too aggressively. This next slide is the K economy that Mark mentioned earlier. I want to spend some time on, because I think if we are wrong about the market in 2026, it can likely be driven by the consumer, because the consumer plays such an important part of our growth. And what we're looking at here is at the bottom left, this is post-tax, so it's after-tax net income. We break this down by quintile. And the top quintile accounts for 50% of all earned income. And if we move to the top right, we look at personal consumption expenditures. And so the top 20% is driving 40% of all the consumption. And then if we look at the bottom right, we look at the top quintile, excluding the top 1%, 47% of the wealth. Then if we add the top 1% in, you could see it's just a staggering number, concentrated, almost 75% of the wealth in the country controlled by 20% of the people.
Jim, what does consumer debt look like these days? You used to provide some information on that.
Well, we've looked at it in the past. Overall consumer debt, we've looked at credit card debt, and it's actually improved over the last quarter from the last time we looked at it. But this is the kind of data that helps us understand why we could have like political or social instability when we have this concentration of wealth.
I would be curious to see this top right-hand chart have that top quintile split off the 1%. I'm wondering about consumer spending, including that disaggregation. I wonder if that would be possible.
See if we can track that down.
Look for it.
Yep.
So this is, I think this slide really helps us understand where earnings are coming from in the market. Travel, leisure, still doing really well, but then you see fast food really struggling. And when you piece it all together with this narrative, it starts to come into focus why that's happening. But so far, the consumer, broadly speaking, is doing quite well and has very manageable debt. So unless you have any other questions, I'll turn it back to Brian so we can review the portfolio.
Great.
Just one other general comment or observation. I don't think you had this up there, but you had the 3-year bull market, and I saw a number the other day that S&P 500 over the last 3 years through September was up annualized returns of 25%, which is incredible. And you talked about, some very high valuations and PE ratios of 23. So we're in potentially some weakness in the consumer. So we've got this nice backdrop that you outlined, but we've also, the market's returned 25% for 3 years, which I don't know if you look back over how many periods that's occurred. It's probably not very many. And maybe this is a segue into your to your section, Brian, of how are we positioned from a risk standpoint given that backdrop, and are we sort of, have you, I think we've been risk on and overweight
For sure, without a
equities,
doubt.
and is that continuing? And
We'll hold that thought.
Great question.
I'm going to go through some of this stuff quickly because I know John's got his valuation report he needs to go through, and we're happy to go into whatever level of detail. Mark's going to talk a little bit about the alternatives piece, but I'm going to go through some of this stuff quickly, but please ask questions as we go along. Landon, you touched on it. We're in the midst of the third consecutive year of really strong equity market returns. In 23, we had plus 20% in the U.S. equity market. In 24, we had 25% return in the equity markets. And when we got together at the beginning of this year, I probably warned you, don't expect to see the same kinds of returns in this calendar year that we did the prior two. And here we are. In some cases in the non-U.S. equity market, we're well north of 20%. U.S. equity market, at least through the end of September, was up 15%. So by all measures, 2026, granted we still have 2 months, a little bit less than 2 months to go, is shaping up to be another really, really strong year for capital market returns. So that aggressive posture, Landon, that we've had has worked in terms of generating extra returns for the city, and as we'll talk about, potentially lowering cash contributions for the city. Over time, those strong returns help reduce the cost of providing the benefits that we do. Jim touched on this earlier. A big reason why non-U.S. equity markets are up so strongly is the fact that the U.S. dollar is in the midst of its weakest return in over 50 years. Arguably, at the end of last year, the U.S. dollar was probably overvalued, so it's not all that surprising to see sort of a decline in the value of the dollar. But don't have to tell you, there's all sorts of things going on in Washington that are causing perhaps foreign investors in particular to sort of divert some of their U.S. dollar investments to other countries, which then has some downward pressure on the U.S. dollar. So returns across all major capital markets really strong this year. Let me go to this slide first, and then I'll come back to returns. So how are we positioned? The target, the long-term target asset allocation of the retirement plans is 70% in equities, 22% in bonds, and then 8% in alternatives. You can see that on the pie chart on the right-hand side. How are we allocated at the end of September? We're a little bit higher, running a little bit higher equity orientation, 73%, a little bit north of 73% at the end of September, a little bit underweight to both bonds and alternatives. We're going to come back to this alternatives piece in a second. In October, we pulled back some of our equity exposure. So we're still slightly overweight, but we took about 2 percentage points of equity exposure off the table towards the end of October. October was another strong month for equity markets, so we participated with that higher equity orientation. But for some of the reasons Jim talked about and the fact that the equity allocation was creeping up, as a risk control measure, we wanted to pull back a little bit, get a little bit closer to the intended targets. Now, I'll tell you, even at a 70% equity orientation, that is higher than what is typical in the public retirement system space. On average, between equities and alternatives, public funds allocate about between 60 and 65% of their portfolio between public equities, private equities, and other alternative investments. So we're at a 70% target. We were running 73. It's been a really good place to be. When we started to talk about absolute returns, it's really helped the results. But again, it's a higher equity orientation and something that we think about because at some point, and Landon, this gets to your question, we're going to want to pull back more on that equity orientation for some of the reasons that Jim's been talking about, stretched valuations, et cetera. So the way we think about it is, are there other areas of the capital markets that we can generate the kinds of returns we need to sustain and support the growth in these assets and reduce the ultimate cost to the city? And we think there are other opportunities where we can generate the kinds of returns we need, but we don't need to take as much risk as we have historically. Again, it's been a great place to be, okay? So we don't have specifics for you yet, but those are the exact things that we're thinking about.
I was going to ask that of how our target compares to other municipalities. So we put these targets in place. I want to say it was like 6, 7 years ago.
Yeah, about 7 years ago.
And I want to say the plan was not as well funded then.
Correct.
So with lower funded status, it makes sense to have more equities to help close the gap.
Yep.
But this, I guess, if we reduce the targets and the allocation to equities, our long-term expected return is going to decline, which plays into the guy sitting over here from our friends from John Hancock.
Yes.
And the risk that we take in these portfolios is clearly tied to contributions that the city will have to make.
Correct.
And if we're, it's what's the sweet spot for risk, and also take into consideration that whatever we don't produce from investment returns has to be made up by contributions. So there's, let's think about what the right balance is. And if
let me give you a little bit of sort of data about what is typical in the public fund world in terms of the assumed rate of return that you're talking about. So John, in the work that he does, assumes over the very long run, based on the way the assets are allocated, 70% stocks, 30% other stuff, that over the long run, we're going to generate a 7.25% return. And in the past, that's been achieved. And we've talked recently, assuming the portfolio stays in the current composition, 70-30, we all collectively believe the 7.25 is infinitely achievable over the long run. So it's an appropriate assumption based on the way the portfolio is currently structured. When you look at what other public funds do in terms of their assumed rate of returns, the trend has been down without question over the last, let's just say, 10 years. The median assumption right now is about 7%. So it's not like we're 7.25 and the average is 6, I mean, it's 25 basis points lower. So it's not materially different, I would argue. But to the extent that we change our strategy, those long-term targets of 70-30, and it has an impact on what the long-term return assumption is, Landon, you're absolutely right. It would require a conversation around what the correct assumed rate of return over the long term is for the new strategy that's being implemented.
And I would just add one more technical answer to your question. Morgan Stanley every year, like many other firms, generate capital market assumptions. So what do we expect X asset class to earn over some time period? For U.S. equities, it is actually our forward assumptions are looking to be less than 7% annually, given our view on valuations and everything. So while it's generally true if you allocate less to equities, you expect a lower return, but there are other asset classes that we actually think can add equal or more return for a better risk profile. So that's something that we'll take into account. And I think, if you said this has been in existence for about 5 years, it's about the right cadence. Typical of public plans that I work with elsewhere, it's about every 5-6 years you take a step back and review the strategic asset allocation. So,
Brian, am I correct in hearing you say that other municipalities have been decreasing their rate of return over the last 10 years?
The trend has been to lower assumed rate of returns.
Are they missing out on all the opportunity and growth over the last 10 years?
So, yes. And I'll just get another data point here. So the most common fiscal year period for public retirement systems is June 30th. So we've got data here as of September 30th, and we'll talk about that in a minute. But as of June 30th, the 12-month return of our plan here was 12%. Now again, that takes into account the higher equity orientation that we talked about, the 70% stocks. The median return of public funds over that same period, again, it's a 12-month return. We can look over longer periods of time, you'll see very similar results, but was 11.3%. So our higher public market exposure was good. We outperformed the average public fund by about 70 basis points. One other point, given that we're in Virginia, so VRS, which obviously a very, very large portfolio, their 12-month return ending June 30 was 9.9. So these big plans in particular hire lots of consultants, have lots of alternative investment strategies, really broadly diversify their portfolio across lots of different pieces. Hasn't really worked in terms of returns. Our portfolio, which is more public and liquid, and it has to be because we're, a frozen plan, and we send out, on a net basis, about 10% of the value of our portfolio every year in benefit payments after the city makes its contributions. We have to be more liquid, but without a doubt, over the last 3 years, that has been the best place in the capital markets to be, public stocks, and in particular, U.S. equities.
and Mark, to your question, one of the reasons why municipal plans broadly have been reducing their assumed return has been, this has been going on for about 15 or 20 years, has been because of the bond market. If you look at bond market for a better part of 10, 15 years, interest rates have been extremely low and suppressed for a variety of reasons, and those typically make up a pretty decent component of a portfolio. So when you look at the typical asset allocation that municipals have, and that component is one of the reasons why expected rate of returns have come down over time.
Yep.
Is there any difference because they're not a closed plan, that their strategy would be a little bit different?
Sure. You can tie up more, typically, the theory will tell you, and in practice this tends to be what happens, that when you have more money coming in the plan and liquidity of cash flows coming in, you can tie up your capital in more illiquid strategies than we can if we've got more money going out like we do. So yes, the strategy would potentially be different. But the fact of the matter remains, over the last 3 years, alternative investment strategies, and really you can go over a longer period of time as well, alternative investment strategies in general, I recognize there's different types, have underperformed public markets. There is no doubt, no question, there's no debate about it. Public markets have been the place to be, and we've benefited significantly from that. Let's talk a little bit about results, and I know we're sort of quarter past the hour here. You can see we're showing third quarter, we were up just under 5%. Our benchmark was up 6%. We underperformed. I'm going to talk about that. Year-to-date period, we're up 12 versus 14.5. And then since inception, we're up 9 versus a little bit less than 9. So markets were strong. We were overweight stocks, but why did we underperform? And we underperformed because of what I alluded to earlier. The active managers we hired and that we currently have in the portfolio are more defensive in nature than the overall market for a lot of the reasons that Jim talked about. You know, the things that really ran since April of this year have been the riskiest parts of the market. Companies that don't make money, quantum computing stocks, things related to Bitcoin. These are the things that institutional quality managers don't hold in their portfolio. And if you didn't hold those in your portfolio, you dramatically underperformed. And that's what's driving the relative results. The important part about this slide, though, is you could put aside the quarter, it's a 3-month period, but you look at the year-to-date period, you look at the since inception period of when we had discretion, in both cases, well in excess of the 7.25%. So that higher return has real implications on the funded status, and it has real implications on the cash contributions that are required from the city. Means they go down.
Can I ask,
Yep.
you said earlier that you pulled back on our equity
We did.
exposure.
Yep.
Was that done in an active way or in a broad-based way?
It was in a very targeted way. So let me talk about a little bit about the way that the equity portfolio is constructed. There's not a slide on here. I just jotted some numbers down. And then what we did in October. There's 2 types of ways you can invest in equity markets. You can invest in index funds and exchange-traded funds, and just to kind of level set, that means the manager of those portfolios is not trying to pick individual stocks that they think are going to do better than the market. If the market's up 12%, that portfolio is going to be up 12% because they own everything, effectively everything in the market and the weights that they exist. The other way is we can hire active managers, and we got to pay them a higher fee to try to pick the right stocks that they think are going to outperform. At the end of September, we had 65% of our equities in passive strategies. Okay, 65%, more than half. It means 35% was active. It's that active piece, which is about a third of our equity exposure, that resulted in the level of underperformance relative to the benchmark. So what did we do in October? And it was towards the end of the month, so as October was a reasonably good month for equity markets, we participated most of that month. We pulled back about 2 percentage points from our equity overweight, and we repositioned that 2% some in bonds, or all in bonds, but in conjunction with that sort of increase in bond exposure, we took those dollars from some of the active strategies. So where we are at the end of October is we're 72% passive, 28% active. So it was done in a very targeted way. We exited completely one active manager, and we reduced some exposure to other active managers to fund that higher fixed income orientation. We still have active. We still believe in the managers that we have. And in fact, if markets are to sell off, not acutely, but yes, it would happen in a scenario like that. But if markets just kind of slowly trended lower, the way that these active managers are putting the portfolio together should and will add value relative to the benchmark. So we like where we're at, given our outlook, but we did, shift things a little bit in October, and that's where we're at today. Okay. Yep.
So going forward, is your expectation that that trend will continue, that we'll be moving more toward passive versus active managers? And then the other piece of it, going forward, you expect the trend to be less U.S. exposure and more international exposure going forward?
I'll come back to the active-passive question in a second. So here is, it's hard to see up here, some of the numbers in the table on the left-hand side break out our equity exposure between U.S. and non-U.S. But as we think about how we're allocated, we're overweight to the U.S. equity market. Believe it or not, given the difference in returns that U.S. and non-U.S. equity markets have had this year, it hasn't really been a significant detriment to our return, given that non-U.S. markets are up 20%, U.S. markets up, I don't know, over 20%, U.S. equity markets up 15% or so. It hasn't been that big of a drag on returns. We have a healthy non-U.S. equity orientation. I don't know that we certainly haven't discussed it. I don't know that we have an appetite to increase it. We've got enough. In fact, if you looked at our exposure relative to other public funds, we probably have a little bit more in non-U.S. equity exposure. We're very comfortable in terms of the regional exposures that we have where we're at today. I would say, with respect to active and passive management, at the margin, there may be a slight increase in passive. But again, we're comfortable. Maybe we get to 75%. We're not likely to go to 100%. The reality is when you have that much in passive management, you have what's referred to as a lot of beta. And beta means if the market's down 10%, well, we're going to be down 10%. Because we have a high equity orientation, and we don't have a lot in bonds, and we don't have a lot in alternatives right now. And again, this is the things we're thinking about. We think it's prudent and appropriate to have some defensive equity exposure, because when markets go down and you have a lot of beta, you need something to protect the portfolio. And that's where we're at today. Markets have just been up straight line for 3 years. And the fact that we have that defensive positioning is resulting in that underperformance. But at the margin, I think, Derek, maybe we sort of inch it up a little more, but I would imagine 75% is about the ceiling of where we'll get. Okay. How are we doing on time? Do you want me to go into some of the other stuff, Landon? Do you want to talk about alternatives? No.
Do we have, is this meeting normally scheduled till 10? Does anyone?
Well, we've been going to 10:30, I think at the latest.
So we have a,
I think I can cover my stuff in about 30 minutes, maybe a little less, so as far as timing.
There's other city meetings at 10:30. There's other city meetings at 10:30.
maybe 10, 15 more minutes?
On the alt side, and so, or 10
Total, or?
because we want to talk a little bit about alternatives.
Okay.
And
Let's
Mark's got
toggle
about
through alternatives for a minute.
I'll try 5.
And then we'll-
and then we can come back
We
to
have
this.
extra time
Yeah.
after that.
Let me go switch up the other deck.
Don't mind.
Well, I can start talking while Brian does that. First of all, it's a pleasure to be here and nice to meet all of you. Thank you. And you guys have a very charming and welcoming city. It was my first time here, and it's, I've had a nice walk around and sampled the restaurants. It's been wonderful. So the goal of what I want to achieve here really is just a high-level overview and an education to make sure you guys understand what you own, given the sometimes opaque nature of alternative investments as compared to stocks and bonds, and explain a little bit about our thoughts, and then going forward and leave it open for questions. So at a very high level, what are alternative investments? And you might have heard, likely have, hedge funds and private equity and private credit, and those are all types of alternative investments. Broadly speaking, very broadly, alternative investments provide the opportunity to invest in opportunities not necessarily available in traditional markets like stocks and like bonds that we all know. And they may invest in stocks and bonds, but they do so with very different investment strategies, putting on a lot of complex trades using derivatives, long and short strategies, et cetera. So that's really what alternative investments are, and there's a wide range of them. Why does someone own alternatives in a portfolio? I know you've all heard the phrase, there's no free lunch, which refers to risk. But that's actually not true. There actually is one free lunch in investing, and that's diversification. And alternative investments, if done right, provide the opportunity for uncorrelated returns, meaning no matter what happens to the S&P or the bond market, if you invest in certain types of alternative strategies, they're designed to achieve a certain total return, irrespective of what happens in what we call traditional markets. That's the benefit of alternatives. Now, yes, you tend to pay higher fees for them, given the complexity and the expertise needed, and we're mindful of that, but that's why alternatives are in a portfolio. And again, it's a very wide spectrum of the available opportunities. There's from the level of liquidity to the level of complexity, but so what I wanted to do is briefly go through the 4 alternative holdings that are held in this portfolio, and what they are, make sure you guys know that, why we hold them, what they're designed to achieve, and then going forward, what we might be doing. So you have 2 real estate focused alternative holdings and 2 hedge fund alternative holdings. The 2 real estate holdings, so we'll start with ARA Core Property Fund. So this is a hedge fund, a real estate strategy designed to go out and buy properties, a diversified set of properties across the entire United States and some global. And the way they make money is they buy the properties, they might renovate them, they might do something with their capital structure, all with the goal of generating a return that's advantageous to the investors, like yourselves. The goal of this strategy is to generate a net return, so after fees, of 6 to 8%. 6 to 8% in the past couple of years, past 5 years, doesn't sound very good compared to the S&P, but that's the point. It doesn't, while they have underperformed just on an absolute basis, they've actually, a lot of alternative strategies, and certainly most of the ones you have actually done what they're supposed to do, uncorrelated returns. So it's important to keep that in mind. And there are times that the S&P will go down, and you will look at the 5, 6, 7, 8% of some of these alts, and you will be happy. So every investment has a purpose. It's important to know what that purpose is, and this is part of the goal of what we're doing here to try to explain it. Now, ARA Core Property Fund, there are a lot of great things that came out of COVID, Zoom, Teams, remote working. On the flip side, the one part of really the major part of the investment market that got hurt by COVID and continues to be is what's known as core real estate, office buildings, et cetera. For reasons I think you can all relate to, occupancy rates of many places are much lower. People have work from home, and what that's happened is it's a little bit of a domino effect where a lot of investors have pulled back from funding new real estate ventures. So a lot of funds have not been able to have the velocity of buying and selling of their existing properties. It's kind of left the real estate market stuck, broadly speaking. This particular fund actually has fared fine. Well, it has not performed great to their expectations, but compared to just about every other real estate fund, we actually have a positive return, absolute and a little bit versus the benchmark. which we are happy about. However, our view on this type of real estate investments going forward is a little bit more muted. So we've made the decision to redeem. So we've been slowly getting back capital from the manager, and that should continue into 2026. Upon which, when we receive the full proceeds, we're going to look to invest in a different strategy going forward. We're also might tie that to, if we look at the strategic asset allocation as part of an update, we can look at the alternative we will look at the alternative strategy as part of that, and what the right parts of the alternative market should be going forward based on our views of risk and return, and we'll invest accordingly. So the next
One quick question. When did you put the redemption in, and how long
it
is it?
started earlier in the year.
Okay. Was there
There's a queue.
queue?
Yes, yeah, like many of these funds, there's, and that, on the lower, the last bullet point, 364 million on the lower right, is the existing queue at the end of Q2, quarter two. That number has been significantly higher, and this is consistent across many mandates of similar objectives.
We've gotten some money back from the investment, but we'll get additional ones the remaining part of this year and probably the first half of 2026.
But this is not, I mean, this not that, what do we have, like 5 million in this or something?
Yeah.
Okay. Do you think, maybe for the next slide, do you think we've sort of reached the bottom in real estate?
No. The reason is because a lot of what's the velocity of what I was talking about, the velocity of real estate transactions has not hit its bottom yet, in our opinion. That, you know, it doesn't translate into the appropriate investment opportunities for core real estate. There are real estate opportunities that do make sense. For instance, the next fund is one that we still believe in and we would still add to. But traditional real estate funds where you go out and buy buildings and fix them up and sell them 10 years later, that has not worked its way through the system, and it might take some further time.
And the other challenge with that market is just the high cost of capital. So the hurdle rate with high borrowing is quite formidable for new real estate projects.
Okay.
Yeah.
And I think, is it just for, you know, our overall portfolio, is it safe to say that for retirement funds, it's real estate, aside from your traditional stocks and bonds, real estate's probably the next biggest asset class that pension funds traditionally invest in? And I would say, what would we have, like, it was like 2% of the portfolios in real estate. That's probably under what other allocations are.
Yeah,
Which has helped.
That's right. That's exactly right. Relative to others, and that's why when we talk about the median returns of other public funds, why we look very different. I would say outside of public markets, it's a close race between real estate and private equity about which allocation is higher. They're both probably around, you know, call it between 10 and 15% of public fund exposure to those.
They're suffering similar issues that they can't turn over their portfolio.
But historically speaking, real estate's been a nice alternative asset to have in pension funds, and
For sure.
makes sense with the long-term nature of real estate, and the pensions are long-term, and it's a nice diversifier.
Yep.
Yes.
Exactly. And that's why we want. That's why we
Clearly
put
a
it
big
in.
market.
Yeah.
Yeah, they're just, I think there will be better opportunities in the future versus right now. And this particular fund, being the structure that it is in the redemption queue, really doesn't lend itself to, it's an open-ended fund as opposed to closed-end funds, which is good and bad. It's good that we can get our money back. It's bad that we can get our money back, so can everyone else. So the next holding is Blue Hour Real Estate Fund. This is something called a triple net lease strategy. So what does that mean? So the investor, Blue Owl, and by extension us as a limited partner, goes out and buys a commercial building, and the tenant pays all of the expenses. So it's very different from the other holding where the investor owns and operates a building. Here, the tenant pays everything. They pay repairs, they pay for maintenance, they pay for insurance, real estate tax, etc. And the investor receives rent. And the way those deals are structured, is for the investor in this particular fund to receive a target return of about 8% a year. So if you look on the lower left, the return has been just under 11% a year, which is very good. And that number right below it, the TVPI, which is total value of paid-in capital, it's essentially how much have you made on your money. It's about 30, so you made 1.3 times money so far on that investment. This is a very bond-like type of investment. It's obviously riskier than a bond because there's no guarantee associated with it, but all of the tenants are what's known as investment-grade tenants, so they're of higher quality. There is risk to the risk here is that the value of the buildings go down at the end when they sell them, but that's typically not what happens. These are high-quality buildings, so it's really it's a very unique and differentiated strategy, and this perfectly fits into the reason of why you would own certain alternatives in a portfolio. It's for this. It's nothing to do with what happens in the stock market. They're betting on the quality of the tenants, and there's a lot of due diligence done on that, and it's been realized. So. And then the next two funds, in the interest of time, I'll hand it over to our partners, are Hudson Bay. So these are hedge funds. Hedge funds typically invest in the traditional markets, but in different ways than a generic stock fund or a bond fund. Hudson Bay is what's known as a relative value manager, meaning they don't take outright bets. They're not betting on something by itself going up or down. They're saying, this part of this company's equity is going to go up, and this part of this company's debt is going to go down. And they put those two trades together. And that's what they're betting on. They're betting on the relative value of two things. So it's a much lower risk exposure, lower risk meaning that you're not outright exposed to the markets. You're betting on their ability to identify opportunities in certain companies and sectors and industries, et cetera. The goal of this fund in the portfolio is they target mid to high single digits through all scenarios. And you can see that they've done that. If you look at their long-term track record, it's been 6, 7, 8, 9% returns annually. It's exactly what we want in this portfolio, and it aligns well with your expected rate of return for the liabilities. And then the last fund is Schoenfeld. Schoenfeld's a little different than Hudson Bay. What they do is they go out and hire 100 groups of portfolio management teams that invest in literally every part of the markets: equities, bonds, commodities, foreign exchange, et cetera. And those teams, their diligence, they're giving a certain amount of risk capital to go make money. And Schoenfeld sits on top of those portfolio managers and allocates risk where they see opportunities, make sure that each portfolio management team is doing what they're supposed to do and staying within their risk limits and not losing money. And their goal is to generate returns in the 12 to 15% range net of fees. So they've basically done that over the long term at the lower end of that 12%, but again, very attractive. And the goal here again is doesn't matter what the S&P does. Doesn't matter what the fixed income market does. These guys, long, short, they're all over the place, underneath the hood, but they're risk managed at the top, and that's the goal of this holding in this portfolio. So with that, I know it's a lot. There's a lot of information here. I'm happy to answer questions now or in the future, or at the next meeting or two we can go even more depth when discuss further. So hopefully you guys are a little more educated now than before.
So just real quick, at a high level, we're underway to alternatives. We're going to be talking internally about filling up that allocation to 8% that the investment policy calls for. Maybe through a strategic asset allocation study, maybe that changes. We obviously can't do anything without the board's approval, so we'll come back and talk about that. But irrespective of any change in sort of the 8% target, we're going to be getting money back from the real estate exposure. We're going to look to redeploy those dollars into something that's going to generate uncorrelated returns relative to the public markets to help us, achieve our overall objective. And just, again, last thing I'll say here is that, we need to generate a return of 7.25% in as low a risk way as possible. And that's ultimately what the strategic asset allocation is designed to do. We think we're getting to levels of frothiness, as we talked about, in the public equity markets. And so we're starting to have those conversations around, are there other ways that can help us meet our objectives without taking as much risk as as we're at. And so that's our job as we see it heading into '26.
Thank you. Any other questions for Greystone before we move on to John Hancock?
Great.
Thank you all. Appreciate it.
All right, so I'll try to kind of put all what they said together on the liability side and then how that ties into contribution. So this is a very similar presentation of what we've had in years past. I will cover the retirement systems as a whole. There are the two separate systems, fire, police, and supplemental. So the appendix will actually break out the results between those two plans, but we're looking at the groups as a whole. And a lot of the commentary from the overall plan really holds for the individual groups. So we'll give a quick overview of the systems, some of the terminology we use in our evaluations, the results for the year. Then we have some projections of future forecasts based on that base case scenario of a long-term rate of return of 7.25. So I mentioned we have the two systems here, the fire and police and supplemental. I think the key thing to note here is both of those are closed to new entrants and have been for quite a while. So that goes a lot into what Brian was talking about in terms of the characteristics of your population and how we see the liability and really the assets moving over the projection period. At this point, you're 95%, I would say, inactive, so people that are collecting benefits don't really expect a lot of growth in the liability in the sense of new accruals or additional benefits being earned. There are 7-8 people currently active between the two plans, so a little bit of growth, but very small relative to the size of the plans. Benefits are paid out under retirement, disability, and death. We'll give a brief summary. And again, I'm kind of going through this pretty quickly to get to the numbers, but let me know if you need me to slow down or if there are any questions here. When we look at fire and police, benefits are paid out at the earlier of 20 years or age 50 with 5 years of service. The way the formula works is your retirement benefit is based on your final average compensation, so average, basically 3-year compensation, and then you can see it's a percentage of compensation times years of service. For fire and police, that's a tiered structure, so a higher percent earlier in the years, and then lower percent in later years. Supplemental works similarly, but not identical. Retirement benefits are age 50 with 5 years of service. Again, we are looking at benefits based on final average compensation. There, the retirement benefit is a flat 2% times final average compensation per year of service. All right. So here's some of the terminology we'll talk about in the valuations. Again, the two main pieces are your assets and your liabilities. When we look at the assets, particularly for the valuation where we're determining the actuarial determined contribution, we use a smoothed or an actuarial value of assets. We call it a 5-year average. What we're really doing is smoothing returns over the preceding 4-year periods. So we're smoothing around that expected return of 7.25. And the reason that we do this is so we get a more predictable value of assets that we're using to determine the contributions. So we expect the market value to fluctuate up and down over, in the short term, and the average value is going to smooth some of those fluctuations. When you have a down year, the average value will defer some of those losses. When you have years of positive returns, you'll see the actual value of assets actually defers some of those gains and will actually lag a little bit behind the market value. We'll get to this, I'm jumping ahead a little bit. Right now, the market value and actuarial value are almost identical, but we do have a large loss that we've deferred. So when we look at projections, you'll see next year, we actually expect the actuarial value to lag a little behind the market value because we have those three strong years that we're talking about are slowly making their way into the actuarial value of assets. That's one half of the equation. The other half of the equation is the actuarial liability. So when we do the valuation, we look at the participants in the system, we project out a stream of payments into the future, 80, 100 years into the future, over the lifetime of your participants, how long we expect those participants to be receiving benefits. Those get discounted back to today to prevent a value as of today using that 7.25 rate that we're talking about. And so that's the kind of the trade-off that we talk about is at a lower discount rate, so that if we were using 6 7/4, 7, kind of what we're seeing in other municipalities, so again, they have different asset allocations. you would get a higher liability. So that 7.25 is actually giving you a slightly lower liability because we're discounting, again, future payments into today's dollars. The two funded measures that we look at then are just, one is the dollar difference between the actual value of assets and the liabilities, and then we can also measure that as a percentage. So typically we talk about the percentage around 75% currently. That's just part of the picture. Again, the other part is that gap between the actual value of assets and liabilities. And then the last piece here is the actuarial determined contribution. So when we update the valuation annually, we collect a new census as of the valuation date, which is that July 1 valuation date. The contribution is two pieces. I mentioned you do have a very small group of participants still earning benefits. So the normal contribution is the cost of those one-year accruals. More or less, it's a rounding error for your plan. The big portion of the actuarial determined contribution is the amortization of that unfunded liability. So the gap that exists between the value of assets and the liabilities is currently funded over an 11-year period. There was a period set in place about 20 years ago where we looked at that unfunded, amortized it over a 30-year, and then each year we're decreasing that amortization period. So where we are today is we have an 11-year amortization of that unfunded, and then each year that amortization period will decrease to get to full funding in about 11 or 12 years. The two key assumptions then that make up the liability when we talk about projecting those payments out and then discounting them back to today's dollars are, one, that discount rate, so 7.25 that we've talked about. The other key assumption is the mortality table. So when we look at participants, we want to project how long do we expect participants to be receiving payments and what that stream of payments will look like in future years. I'll jump ahead because this is one of the key assumptions, and we're recommending a change this year, which is increasing liability. So I want to spend just a few minutes talking about what that is. In prior years, the fund has followed IRS mortality tables that are prescribed for corporate pension plans, private pension plans, sorry. My understanding is historically that has been slightly more conservative than maybe some of the public plan retirement mortality tables that were there. So we were building a little bit of conservatism into the valuation of those liabilities. When we get to this year, in May of 2025, the Society of Actuaries produced a new public plan mortality table. So it's an updated mortality table reflecting, you can see here, about 58 million life years of exposure. The period, I believe, was from 15 to 2019. So it's right at the edge of COVID. They did get some data for 2020, but they excluded that because they didn't want COVID to not adversely impact the mortality, but have too large of an impact on the mortality experience. So when we look at this new table, considering that the IRS table, again, it was a corporate pension plan, it had been slightly more conservative. There were recent updates made to the IRS table that took away a little bit of that conservatism. I think when we look at this year with this new table probably, in my opinion, better fits your plan. It studies public pension plans. They did release 3 tables that broke it out among teachers. They have a table they call safety, which is similar to your fire and police, and then general. So again, my opinion is that this is going to more realistically fit, or more likely fit, the characteristics of your pension plan, given that you're covering people in the public sphere. But it does have the impact of increasing liabilities overall about 2%. So we'll see that when we look at both the funded status of the plan and the contributions, as this will work its way through that. But it is in the current valuation. And I have shown figures in the slides to just give you an idea of what that impact is on the contributions, just so you're aware of what that impact is.
And so, John, just to be clear, when you say conservative, it means that the public pension tables expect people to live longer.
Correct.
Than the old table. So that means we've got to pay benefits over a longer period of time than under the previous table, which means the liability goes up, just so.
Yeah. Thank you.
That has usually not been the trend for fire and police.
I agree, and I think part of the reason is, as I mentioned, there was a recent update on the IRS tables where they were using a private plan mortality-based table. There's also some legislative impacts on the mortality table from the IRS that the private plans are using, where there are certain COVID adjustments that are made. Again, that's a legislated adjustment. And the other portion of this table is there are really two pieces to the table. There's the base table that we're using, that's the public plans tables, and then we are projecting those tables out into the future. We call it a generational mortality projection. Basically what that means is we're building in anticipated future improvements in mortality. So if you look at a 45-year-old today, they would have slightly higher mortality, say, than a 45-year-old 20 years into the future. I agree it's slightly not what you would expect going from private to public, but I think some of the increase here is those legislated increases that we saw on the private side. We're kind of essentially backing that out and using the most recent mortality improvement scale from the Society of Actuaries. It's actually called MP 2021. The Society was under a pattern of releasing new mortality improvement scales on an annual basis. They paused that once COVID data started impacting things because it was going to, skew things and provide results where it would have been too much, excess mortality. So their take has been kind of more like a wait and see approach. They don't want to go too far in scaling back mortality improvement and then potentially have future losses in the future. So they're kind of just, again, more of a wait and see approach of waiting for more data to come in. Their view is that the current scale is still an appropriate scale. And then just one other anecdotal piece of this is I don't have specific data of exactly what all public plans are using, but I do attend annual meetings, and in one such meeting they took a very informal survey. So again, nothing hard data, but just in terms of what are most public plans using for their mortality improvement scales, and it's about 90% of them are using a standard table. That MP 2021 table that we're using. So I do think it is the combined impact of those two sets of assumptions that is causing the slight increase in the liabilities here.
Again, this is a closed system. So a lot of our retirees, I don't know what the average age is anymore, but it was getting close to 75 for
Yes.
the Portsmouth Supplemental system. I'm not sure what it is for fire and police. But this seems to me to be more worthy of a plan where you have a younger participant group in it.
So they do look at, it is a study of both employees and then people that are currently receiving pensions. So they are studying the range, and there are separate tables for employees versus those currently in pay. So this is not a table just based on an aggregate population. What we're using is, they call them the annuitant tables, so specifically looking at people in pay. The other thing, and obviously this is going to impact liabilities and contributions, but this isn't actually changing the benefits that you're paying out to people, right? So we're not fundamentally changing the amount of money that you're paying to people. We're just saying, based on these tables, we think people will live a little bit longer and get slightly more payments. So it's trying to better allocate to the time periods, when we expect those payments. So what this is saying is we think that people are going to live slightly longer, receive slightly more payments, but we're not actually changing the amount of payments that we paid, if that makes sense. So it is, not that there's no impact, but in terms of, it doesn't impact the overall payouts, it's just trying to get a better representation of what we think that liability as of today is. And again, obviously it's not exact science, because we're predicting mortality into the future. So in some sense, I don't think there's a right answer here. It's just using the latest available data to us and making our best assumption based on the data we have as of today.
Just glad I'm not going to live longer now.
If that is your takeaway, I'm quite happy with that.
I mean, as this plays out over time, we will, our actual experience will be based on how long people actually live. Is it safe to say that the takeaway from this is that using the more conservative mortality tables, we might have to contribute a hair more than we would using the...
Correct.
But it's not like the contribution, because of this, instead of $10 million a year, it's going to be $12 million a year. It might be, you probably know the numbers, like maybe 100,000.
It is closer to, it's not the 2 million, but it is 750 between the two plans.
Okay.
Over the period.
Not insignificant.
And some of that is the returns on the assets are helping dampen some of that, I mean, the change, but in terms of, I look at, when we were, so right, I'll show the numbers, but the recommended contribution is about 8.9 million. Last year, when we did our forecast, we were projecting about 8.3 million. If we look at this 2 years ago, we had projected about 9.4 million. So we're in line with those projections, maybe slightly lower than what would have been even 2 years ago, and that's where those excess returns are helping to.
That makes sense, and the city is it's like contribute now or contribute later.
Yeah, and that's, I think,
It's
the
going to
point I
have
was
to be
trying to make about we're not
contributed.
changing the overall cost. It is maybe accelerating some contributions that you would otherwise have to make.
But the decision on what table to use, I don't think that's under the purview of this board. That's like accounting with the city, and how much leeway does the city, I guess, have with which table to use? Do we have to adopt that one? I don't know, is it an accounting decision?
I mean, we did talk about this briefly feels like months ago, but I'm sure it was just a few weeks ago. And I gave them the go-ahead, but I asked that they flag it for this committee for awareness.
So this is separate from the accounting valuation. So we do two different valuations, one on the accounting side and then one to determine.
This is just for the funding.
This is just to determine the funding, right? So Jeanette and I had raised this issue with her when we did the accounting valuation. We are also using this same table. So previously there had been a slight disconnect between the mortality table you were using on the accounting side and the funding. Again, I think some of that was because prior to until recent updates, these IRS tables were actually slightly more conservative. Now the IRS tables are actually producing slightly lower liability, so we're kind of building in a little bit more of that conservatism, but aligning what we're doing on the accounting side.
So you've got whatever the standard is for public municipalities to use for accounting, and that's maybe slightly different than this?
Correct. So I think there is a little leeway.
I forget what it is. I don't know what the public accounting, it's not, whatever the public equivalent to GASB is.
Yeah,
GASB.
And the tricky thing about this plan is because it's so small, you're right, you'll have your own experience. There's just not enough experience for this plan to do any sort of credible mortality study. So you don't have the lives that we would need to do to like really hone in on your population and say, we think we're only going to see 98% mortality or 102% of the base tables that exist.
We only have 1,000 people is not enough for the law of large numbers
Correct.
to work.
Not even remotely close to what you would need in order to actually do a credible mortality study with your plan. So in that regard, we're kind of, I don't want to say stuck with, but using these industry tables as our starting points here.
But Landon, to your point, it's the actual experience as we go through time that's going to dictate ultimately what the city needs to contribute. I mean, if we get 6-7 years down the road and we find that, it's going to sound harsh and I don't mean it that way, more people die than the actuarial tables thought they were, you're going to have like a gain on the assumption, which is going to reduce the cash contributions at that point. So it really is all about how quickly the city puts cash into the plan, because there's only two sources that we can pay benefit payments from. It's the amount of money that the city contributes and the investment returns. And we can make all sorts of assumptions on both, what we think they're going to be, but at the end of the day, we'll know in hindsight whether those assumptions were right or wrong.
Any other questions before I move forward? So this is an overview of the participant systems. Again, really just to highlight here that there are very few actives and the large portion of participants are in pay. So what that means is retired people that were former employees for the city have retired and are currently receiving benefits from this system. Here's a 5-year history of the cash flow. One of the important things I want to point out here is when we look at the cash flow for the system, and Brian touched on this earlier, is the benefit payments make up a large percentage of the assets. Because you are primarily, almost entirely in pay, you're paying out, as you can see here, about 29 million in benefits each year. Even if we get those 7.25 returns and the contributions that you're making, we don't expect to see that the portfolio is growing in dollar value. So you're not going to if you're at like 200 today, we wouldn't expect to be at 205 next year, even with positive returns. We actually are going to see the portfolio start to shrink, so you see negative cash flow. Again, that's a function of the dynamics of the plan. So when you see negative cash flow, that doesn't necessarily mean that the fund is not performing as expected. It's actually expected that we'll see negative cash flow. Where we make up that gap is as those benefits are paid out, you're also shrinking the liability. So between the returns and the contributions that are made, what we expect to see happen in the future is the liability will actually shrink at a faster rate than the assets, and that's where you start to close that gap. So you're not necessarily accumulating assets, but the goal is to have the assets decrease at a lower rate than what we're seeing on the liability side. And again, we mentioned a really strong 3-year period of returns in the double digits. You can still see in 2 of the 3 years we see negative overall cash flows. Does not mean that the system is not performing. This is what I was referencing when we talk about the market value versus the actuarial value of assets. We see these returns. These are estimated returns based on average cash flows, so they're slightly different than what Brian was reporting. But again, the picture is consistent of 3 really strong years of returns in the most recent period. We go back to 2022, a down year for the market. The way that the actuarial value of assets is working is these returns are being smoothed, so they're incrementally being recognized over the 4-year period. For 2025, it works out that basically that large loss that we're deferring from 2022 is almost exactly offset by these gains that we're not fully recognizing from 23 to 25. When we go ahead to the projections, we'll see that we actually anticipate a dip in the funded status based on that actuarial value of assets. Because this large loss in 2022 will be fully recognized in the actuarial value of assets, these 3 years of gains are still not fully recognized in the actual value of assets, so they will start to trickle in the projection period. But right now, they're almost identical between market value and actual value of assets.
And our smoothing period is 5 years, or is it 8?
It's 5. It's the returns over the 4-year period, but essentially it's a 5-year average around that expected return of 7.25. Here we look at the funded status, and these are the 2 different measures I mentioned. Again, this does include that liability loss. On the mortality side, you can see at the bottom here, it's approximately $6 million, give or take. And so the 2 measures that we look at are, when we look at actual value of assets over the liability, the funded status is just the value of assets divided by the liability. And you can see we're pretty consistent around that 75% over the 4-year period. The other way we can look at this is the unfunded liability, so that's the dollar gap between what you currently have and the liabilities. And we've touched on this again already, is that the way you're making up the gap in that unfunded liability is a combination of returns and then anticipated contributions from the city. That's the piece that we're currently amortizing over 11 years to produce, I'll go ahead to that, sorry, the actual determined contribution. This next slide looks at a funded status reconciliation from the beginning of the prior fiscal period to 6/30/2025. The main difference here is this is using the market value of assets, not the actuarial value of assets. Again, a lot of the stuff we talked about here, we do anticipate the liability growing. That's that interest cost each year. That's the time value of money. So all those future cash flows that we're discounting back to today, they're 1 year closer to being paid out. The benefit payments to retirees are going to shrink the liability. On the asset side, the benefit payments are also coming out of the assets. We have contributions from the city and investment return adding to the asset value. But we can see here that, in any given year, you expect the liability to drop by about $9 million. The 7% return and the contributions are going to add something like $20 million or so, roughly. And so that the asset value might drop, $5 to $6 million. The market value of assets might drop, $6 to $10-ish million or so. So that's where you're starting to close the gap in that funded status.
This is with the new assumption, right? That's
yes, and so that's part of that liability gain loss. That's 6.7 is we see
mortality table.
Most of this mortality table. We did see a small census loss this year, and updating those when we look at the new census for 2025.
So John, I just did a real quick ballpark calculation. If the mortality table assumptions were not included, it looks like the funded status from the beginning to the end of June of this year would have been something like a little bit less than 76. Does that?
Yeah,
Is that right?
Yeah, that's around that
70, like 75,
2.5%-ish
75 and a half-ish.
that we saw in the
So they're
last laws.
setting that assumption change aside, there has been improvement in funded status. And then just to give you a sense, I looked at this before the meeting. The average, the median funded status as of June 30, 2025 for public retirement systems is right around 78. So it's right around that 80% level. So we're, a stone's throw away from that. But I would presume that those numbers don't include the potential change in mortality assumption that other plans may be making as well. So just gives you just a kind of framework of reference as to where we're at.
And then we have the same reconciliation from June 30, 2025 to September 30, again, just on the market values. It doesn't reflect any smoothing. And we can see that the positive asset experience over the period has also served to increase the funded status. Showing here a history of the funded status. I think this looked a lot more interesting 2 or 3 years ago before the pension obligation bond was put in place. You can see since then we've held, relatively steady in that mid-70s range, a slight dip in the early 20s as expected, but that's come back up. So here's the recommended contribution for 2025. As I mentioned, that normal contribution is more or less just a rounding error in this. That accrued liability contribution is the amortization of that unfunded liability. Again, this does reflect the increase in the liability for the mortality table change. Again, you can see the contributions have held relatively steady in that slightly higher this year, about 8.9 million. And the mortality table is increasing the contribution about that 750 I mentioned.
I think on the previous chart it said 11 million. Didn't the city contribute a little bit extra one year? Was that last year?
There's been extra contributions made to fund the supplemental payments that are going out. So this does not reflect those supplemental payments. I think that might have been, I think it precedes the number shown in this slide where there were extra contribution made, but there were some, it was like a refinancing, I think, of the pension obligation bonds, and some of those proceeds went in, but I think that's before the dates on this slide.
Flip back 2 slides? One more? Oh, no, it says the 8.1. Okay.
You're right, Landon. There was a year, and it related to the refinancing of the pension obligation bonds. I think that was before 2022.
Okay.
I keep trying to jump ahead to this slide. We're finally here now, but this is the one I wanted to mention is, again, with the smoothing of the actual value of assets, these gains that we've had over the 3 years are not fully recognized in the asset value that we're using. So we do anticipate an increase in the contribution from about 9 million this year up to about 10 million in 2026 as that 2022 loss is fully recognized and before some of these gains that we're seeing make their way into the system. And then you can see it starts to kind of dip down and level out about that 9.5 million contribution amount after that. Again, I was talking with Jeanette earlier. This is just a baseline set of assumptions. So this is based on our long-term expected rate of return of 7.25. More of an idea of directionality. And again, things like with the actual value of assets, we know that we're going to see a large loss coming through next year as that loss is fully recognized and before some of these gains that we're seeing make their way in. So we do anticipate an increase in the contribution and a dip in the funded status. But then over time, what we're seeing is these contributions are starting to bridge that gap along with your investment return. And that's where we start to see the steady improvement in the funded status over the projection period.
Pretty impressive. By 2034, we'll have 18 million in unfunded liability left. That's it.
And that's, again, because we're closing that amortization gap. So we're at 11 years, so I think this is the last or the second to last year before that comes down. And that is the function or purpose, I guess, of closing that unfunded liability, is that to move to a point where you're closer to or at full funding.
Well, the first quarter of this fiscal year, we're ahead of this. with
Lock in those
June to
gains.
September being so strong.
Yeah.
Sorry, yes?
My responsibility is to the city, and normalizing this, smoothing it, I'd like to see it a bit more than what you've done in there. So any fluctuations that we have from year to year in our budget make a big difference in what we need to fund the city right now. Normalizing this and giving us a fixed number that we can sit down with accounting and deal with makes life a lot easier. I've asked a couple times for the formula to help me at home generate some normalization in this curve, and the formula that I've gotten back has been incorrect, and when I resubmitted to get the corrections, I was blocked in getting that information, so I'm a little disappointed in my ability to give my recommendations to the city from the data.
I can certainly share the calculation of what the smoothing bases look like and what we anticipate them to be over the projection period relative to the market value of assets. I will say the 5-year smoothing is a very common smoothing approach amongst municipalities. And again, it's in up years it works against you, but in the down years, so if we looked at this 4 to 5 years ago, it did serve as a buffer to those large losses, so you're not immediately recognizing them, so that we can do, to your point, it does help in the budgeting, and that's what we're trying to show here, is we do anticipate that contribution increasing, but the AVA should serve to make this a little more predictable, so we're not as tied to those market fluctuations.
2027 on, I see, but that 10.2, 8.9 to 10.2 bothers me.
So I can, like I said, I'm happy to share the calculation details of how we arrive at that.
I mean, I'll just say that this is a formula that's been used for a number of years. It's not exactly magic, and the city doesn't have to do this. It's voluntary, but this was a plan that was set in place a long time to try to get to fully funded, and yeah, it's supposed to have smoothing, but it's clearly not perfectly smooth, so that you do have some fluctuations year to year.
Well,
But that's, I mean, this is how much the city contributes. I don't think is this board's decision.
And smoothing doesn't necessarily mean that the actual is going to be always higher. You can't have a method where there's significant bias that the actual value is always going to be higher than the market value. So we are, again, in those years where there are positive returns, they're just going to be slower to come through in the same manner that when there are negative returns, those are also slower to come through. I mentioned if we look at, back a couple years of projections, last year for 2026, we were projected about 9.6. In 2023, we actually projected that contribution of about 11 million. So it is coming down because of these positive asset returns that we're seeing. But again, given but given the nature and the way that the actual value is working, this is a trend that we're expecting because we're still slowly recognizing some of those losses. But prior years, the slower recognition of those losses would have helped to keep contributions down. So this is a function of that methodology.
I understand.
But yeah, I'm more than happy to share with you the bases that exist and the calculation between, when we go, looking back at the market.
I've seen the calculation once already and plugged it into my computer, and it was wrong. So
Okay.
we tried to correct it, and the corrections that I got were not correct
Okay.
either.
But yeah, I'll
it was
work
a
with Jeanette
disappointment.
to make sure we're giving you the information. If you have any questions, happy to talk through those.
Is there any value in considering a more extended smoothing period, like an 8-year? I know I've seen other plans where the volatility between 2021 and 22 started to force the retirement board to think about, okay, should we smooth this out over a longer period to kind of stabilize our contributions a little more? Or what are your professional thoughts on that?
My concern with that would be if you had an active plan and you were
Right.
looking at a 30 or really 40-year horizon, you had significant accruals, so it might make sense to use a longer smoothing period. Given that that is not the plan that you have, and in some sense, we're winding this plan. I know it doesn't look like that, but conceptually, right, this plan is shrinking year over year. So I don't necessarily think it makes sense to use a longer smoothing period, because at some point, we're going to get to the end of this, and we'll probably actually want to look at almost like an opposite discussion, because, you know, if you get to full funded, either on an ADA or an MBA basis, you don't want to put in more money than you need to, and so, you know, that's a discussion for not anytime immediate, but that would be my concern, is a longer smoothing period kind of goes against the dynamics of this plan as it is right now.
Thank you.
And I guess I'd just point out one other thing, since, you know, with Mark here being the only participant, it's clearly not a decision of the board members of the contributions. That's a city decision, but more contributions are better for participants. I'm sure Mark would like the 10 over the 9. Get the plan funded faster is.
I won't argue that.
Any other questions or comments? As I mentioned, that's all I had today. The appendix does include a breakdown of liability split between fire and police and supplemental, if you would like to see those two plans separately.
I'm okay not seeing them separately unless others want to see them, the separate plans.
Okay. All right, thank you.
Thank you.
All right.
All right, well, that ends our presentations of our guests. Any more comments, questions, concerns before we adjourn? Okay, thanks again, and hearing no more questions, adjourned.